Ladies and gentlemen, if I can get you to reconvene in the main room. Is this his? Okay. I'm going to introduce Eric Rosengren, the president of the Federal Reserve Bank of Boston, my hometown, a graduate of the University of Wisconsin, 4 years behind me. I did not graduate. 4 years behind me, so he has a tremendous education, and he's from the right city. You should listen to every word that this man says. Thank you very much.
Thank you very much. Can people hear me? I like to wander around. I don't like to sit at a desk. So if people can hear me, okay. Is this okay? Great. So thank you very much for inviting me. It's been a very scintillating conference so far, and actually we had some very nice discussion over both dinner and drinks last night, and that's one of the advantages of these kind of conferences, is it's really useful to have person-to-person interaction, really understand some of the issues that people are facing. And it's certainly an honor to be here with Charlie Plosser. As I go through my slides, you're going to see that a lot of the comments that he made are actually quite consistent with my slides. So there are areas where we disagree, but there are a lot of areas where we actually do agree. And it's in some of the areas of policy where we disagree that tend to get emphasized. But I'd say both on bank regulation and a lot of the way that we see the economy, it is quite similar. So in the first part of my talk, I think is going to be very similar to some of the comments that David and Charlie and a lot of the other panelists have talked about. My topic is actually somewhat unusual for a central banker, because normally we pretend like there's no fiscal policy at all when we give our talks. But I decided since I was coming to Europe, it was going to be kind of hard not to talk about the fiscal side of the house. I'm not going to talk about the fiscal side of the house in Europe. I'm going to talk about it in the United States, but I think there are obviously lessons on both sides of the Atlantic. So fiscal matters have been a subject of very intense debate. Frequently in the United States, we actually hear it in the context of what's going on in Europe, particularly in England, but also on the continent. But it's been a very important issue in the United States as well, and I'm going to have a series of slides that kind of highlights how much fiscal movement there has been over the last 2 or 3 years. Several of the panels actually talked about it. I'll have a couple slides that just emphasize it. And that's even before, so that's historical data, so it doesn't have the effects of the tax increases or the effects of the sequester in. When you include that, there really is a fair amount of fiscal austerity going on in the United States. So I want to emphasize at the outset that long-term fiscal sustainability is very important, and I certainly wouldn't deny that. But we definitely have the capacity to have some choices about how quickly we do it in the near term. And so one of the considerations that the Federal Reserve has to take into account is if fiscal policy is going to be much more restrictive and we care about economic outcomes, then monetary policy is going to have to be easier than it otherwise would be. So the stance of fiscal policy is relevant as we think about what the stance of monetary policy should be. And I think that that is something that probably doesn't get enough attention, and so that's going to be the focus of some of my comments. So I do want to highlight an area where maybe Charlie and I disagree a little bit, and that area is in terms of, is the accommodation that we've been having been beneficial for the economy? And I'm going to argue that actually the quantitative easing program that we have had actually has made a pretty big difference, that the interest-sensitive sectors in the United States are performing quite well. And so since the interest-sensitive sectors are exactly what we would expect to be affected by the quantitative easing, that some of the improvement in the economy is directly attributable to some of the things that we've been doing in monetary policy. In fact, I'm going to make the argument that while monetary policy hasn't completely offset the fiscal austerity that we've had, in the absence of that monetary accommodation, we would have a much worse outcome in the United States. We wouldn't have seen the kind of improvement that we have seen in labor markets. So I agree that the labor markets are improving, but I think it's at least in part that monetary policy has been able to offset some of the fiscal policy. And I would also highlight that when we think about the appropriate monetary policy, we have to think about what we think fiscal policy will be. So we don't get any vote on fiscal policy, but we have to take fiscal policy into account. Many people did not expect the sequester in the United States was going to occur. In fact, by design, the sequester was designed not to occur. It was supposed to be so unpalatable for every single politician that the decision would be that we would get a more rational choice. Unfortunately, because of the gridlock in Washington, the choice that nobody wanted was the choice that we got. The result was we have a fiscal policy that's been much more severe in the near term than most people would choose, and many people would argue that it's been misdirected. It's not focused at the parts that we most need to correct, and instead is cutting where we don't necessarily want to cut to the same degree. So interest-sensitive sectors have been growing fairly well. Overall GDP growth has been slow, and so some people have argued this is an indication that monetary policy hasn't been effective. I'm going to argue that GDP has been slow in part because of the components that you look at, and I'm really going to focus on what the difference is between those kind of components that monetary policy can have some effect on and those components that monetary policy can't have a direct effect on. So when I was in University of Wisconsin-Madison and we talked about GDP accounting, my eyes glazed over. I thought, why would I ever want to learn anything about this? And I would say that over the last several years, I've spent more time with GDP accounting than I care to, but nonetheless, it actually has been very useful. So this is a component that most people don't have any idea what the slide is saying, so let me explain it. So it's growth in real final sales. So when it's final sales, we're taking the inventory out. To private domestic purchasers, private means not the government, domestic means not the foreign sector. So what is this chart showing you? It's basically showing households and firms. So think of it as C plus I. So it's ignoring all those other elements. Now those are the things that in some sense monetary policy can have an impact on. We can't have an effect on G, or not a direct effect on G, but we can have a pretty direct effect on C plus I. So if you think about residential investment, interest-sensitive sector. If you think about auto sales, that's an interest-sensitive sector. You could argue about how interest-sensitive the business fixed investment is, but most equations for investment actually have an interest rate in it. So there are at least some component of that. And if you look at this growth in real final sales to private domestic purchasers, I'd focus on 2010 to 2013. And you can see that that line fluctuates between 2 and 4%. Well, what that says is, on average, we've been growing faster than 2%, actually significantly faster than 2% for that C plus I component. So if this were the GDP series, this would have been a pretty good outcome. We would have had growth that was sufficient to be able to get the unemployment rate down at a much faster pace than we actually did. So that alone, a pretty good indicator that monetary policy is having an effect, because these two components that we have the most effect on actually is growing at a fairly solid rate. Now let me add one more element to that chart, and that added element is that it's both domestic and private domestic. So the difference between those two lines is government spending. So if you look at 2010 to the right, you can see that there's been a pretty big difference, which is the fiscal austerity that's been occurring in the United States. So just looking at that slide, you can see that roughly to all domestic purchasers, you get a number very close to the 2.1% that people were talking about in the last panel, which is the economy's been growing roughly a little closer to 3%, but when you take in the fiscal austerity, it's been growing closer to 2%. I'm going to show you a couple slides in a minute that are going to highlight how unusual that actually is. Normally coming out of a recession, fiscal policy is not a major constraint. It actually usually is boosting the economy rather than subtracting from the economy. So I think this slide highlights that fiscal policy has been important. It's one reason why we've been growing at the 2% rate. It's one reason why we're not seeing as much improvement in labor markets as we might have hoped. But that you take the government out, we're kind of getting the outcome that we want. Pretty decent growth from C plus I. This just shows you just the growth in real government spending. And a couple things to note. During the financial crisis and through the very severe recession that we had, government spending actually did work in a very counter-cyclical way, very positive. But you look to the right after the recession ended, you can see that by and large, almost all those bars are negative and quite substantially negative. And that's true not only, so you look at the percent change at an annual rate, so you're getting anywhere from 2 to negative 8%. Those are pretty big declines in government spending. When you look at it as a component of GDP, it highlights that as a component of GDP, it's actually it's the same information shown in a different way, which is as a percent of GDP, it's actually an important component. That having a very restrictive government spending has an impact on the GDP that you actually see. And in fact, it's saying that between 0.5% to 1%, depending on exactly what period you're focused on, was taken away from the kind of growth we otherwise would have seen because government spending has been quite negative. Now, in the United States, we have both the federal policy and we have the state and local. State and local actually is a good bit larger than the federal government. So given the way that spending actually occurs, all the spending for schools, for police, for firemen, that's all state and local. All the spending for the military, other types of national things go to the federal. You can see that through most of this period, state and local's been pretty negative. And actually, it was very negative coming out of the recession because most states in the United States are required to have a balanced budget, which means if they have a big shortfall in taxes, the result is they have to cut spending right away. That's actually what they did. So state and local spending decreased very substantially. You can see as you move over to 2013, that's become less of a drag, and actually most forecasts have that starting to be positive. So state and local situation has improved as the economy's improved, taxes have improved. That gives the capacity for state and local government to stop cutting. Federal, though, on the other hand, is in the process, as a result of the sequester, in being much more negative than it had been. So it was already a negative drag, but going forward, you're going to expect that unless there's a change in fiscal policy, it's going to be a fairly serious negative drag in the coming quarters. This shows you the growth in government spending during both the current and the previous three recoveries. So what it is, it's indexed to the trough. So this is just looking at each quarter from the trough of what happens with government spending. So the 2009 quarter two is the current recovery. And if you look at the blue line, you can see that we've been decreasing relative to the trough, our government spending. So it's been a fairly big negative impact. If you compare that to the green line, so 1982 in the United States was a very severe recession. One of the reasons we came out of that recession so well is because government spending followed a very different trajectory. Government spending grew very rapidly, and we had a very rapid recovery. Now, there were other components of that. It wasn't just government spending, but there's a dramatic difference. Those are the two most severe recessions and recovery periods on the slide. And there's a dramatic difference between what you see from the green line and the blue line. So one of the reasons that we've had a very, very slow recovery is that fiscal policy has been very, very different than what we historically experience. In fact, you can see the purple line, it's sloped up. Red line, government spending was roughly, didn't have an effect. But the blue line is the only period in the four recoveries that we've had where government spending was really a drag on getting the economy going. This shows you it on an employment context rather than a spending context. So I'm showing it to you in two ways. One is for private industries. One is for all industries. The difference is telling you what's happening in the government sector. And again, you can see that there's a difference, that the government sector has been one of the reasons why employment hasn't been growing more rapidly. So that I think everybody who looks at the employment data certainly knows that there has tended to be a negative number every time we have an employment report on the government sector. Pretty decent positive number by and large on the private sector, and that's continued. Well, that also is obviously a constraint on how quickly we're going to get back to full employment. So the effects of fiscal restraint, one, they've been quite notable. It's an important component of why we're not getting better growth in the economy, is that in the United States, fiscal policy has been quite restrictive. Sectors that are sensitive to the accommodative monetary policy have been responding. So that C+I have been growing at a pretty good pace. That monetary policy has ameliorated but not fully offset the impact of the fiscal restriction. So we've gotten a 2% growth overall, but that 2% growth overall is reflecting negative fiscal policy, but a positive effect from the overall. And we've only had a gradual improvement in labor markets. Now let's talk a little bit about inflation. It's a topic that came up in Charlie's comments and in a lot of the question and answer. So I think it is useful just to look at the underlying data. So the Federal Reserve has set a 2% target. Charlie emphasized that in his comments. It's tied to the PCE, so it's a particular inflation target that we have. So we have a 2% target, and you can see if you look at the core PCE, which takes out the food and energy, we've actually been undershooting fairly significantly over the entire recovery period, the inflation rate. If you look at the blue line, you can see that there have been periods where they have diverged, but they tend to diverge when we have oil shocks. Those tend to be fairly temporary and transitory, and that when the blue line and the red line differ, the blue line tends to come back to the red line, which is that the underlying core inflation rate has actually been surprisingly well behaved. And if you look at the far right, which is the most recent period, you can see that whether you're looking at the blue line or the red line, whether you're looking at total or core, we've actually been undershooting our target by a fairly substantial amount. Now, I certainly agree that expectations have been well anchored. And as Charlie emphasized in his remarks, that's really important, that it continues to be well anchored. And I think it is well anchored in the United States, in part because we've been so clear about having a 2% target. So I think that's been very beneficial during this period. But nonetheless, you have to look at that and say, if we continue to have inflation rates that are persistently below 2%, you do worry whether they'll continue to be well anchored. So I do worry about inflation, but those people that have been very concerned that our inflation rate was going to be substantially above 2% have to explain why we've been below 2% for most of this recovery period. I don't discount the fact that we have to think about our exit strategy. I don't discount the fact that we do have to worry about inflationary pressures down the road. But in the near term, my biggest concern is that inflation's been trending lower, not higher, and lower by a fair amount. So if you look at both total and core PCE, we're roughly in the range of 1%. That's a pretty big miss. If we had a 3% inflation rate with a 2% target, I think there would be a lot of concern about how much we were missing on the upside, but we should be equally concerned about how much we're missing on the downside. So with the low inflation, by itself, I think that expectations are going to be well anchored. We had a discussion of the Japanese situation in the earlier panel. I think one of the things that happened in Japan is that they had a pretty low inflation rate, and they got some negative shocks. It probably got a bit lower than anybody anticipated or that anybody wanted. So if you're in a low inflation environment, you're not necessarily going to get a change in expectations unless you get that kind of negative shock that you're not anticipating. Now, a negative shock, by definition, is not something you anticipate. So I'm not expecting we're going to get a negative shock. But the longer we stay well below the 2% target, the more concerned I get that we could potentially get a negative shock that would start making expectations not as well anchored. So even though we have had stable expectations, I think there are risks to persistently missing on the downside. So when I think about what the implication of that is, if inflation is low and has been low for most of the recovery period, we do have to be concerned if we allow that inflation target to continue to be missed from the downside. That gives us more room to be more accommodative than we would have been if we had been at 2% or higher than 2%. So when I think we have a different situation in the United States than you have in Europe, in that we explicitly have a dual mandate, but if we're below target on the inflation and above target on unemployment, then that indicates that we should probably have a larger bias than we otherwise would to having a faster growing economy. I think that's reflected in the policy that we've actually had. I think that's one reason we've gotten better growth than most of the rest of the developed countries that have chosen to have a more restrictive monetary policy than we've had in the United States. Now, one reason that you'd be concerned about expectations is this looks at the 3-month T-bill minus the core PCE inflation rate. So it's trying to get at implicitly what the slide's doing is it's giving you a real rate of return, assuming that the 4-quarter moving average of PCE is inflation expectations. So this is assuming that inflation expectations don't stick at 2%. They instead gradually move as the inflation rate moves. You can see that since we've been at the zero lower bound, most of the movement in the series is going to come from movements in the inflation rate. So if this is the way that you set expectations, and you can look at an awful lot of economic models that basically have the expectation set this way, you can see that you're getting a real return that's moving between -1% and -2%, primarily driven by what's happening with the inflation rate. As the inflation rate goes down, we actually have an increase in real rates. Well, higher real rates is not what you want to have if you want the economy growing more rapidly. So this is the exact antecedent to the idea that we want to hit our 2% target. One reason we want to hit our 2% target is that we want to continue to have pretty negative real rates. Those negative real rates are going to affect households and firms in their spending decisions. One reason Japan's had such a difficult time recovering is if you have a negative number for inflation and a 0 number for the interest rate, you get positive interest rates. Positive real rates at a time when you don't want positive real rates is not a good thing. So that's exactly why we do have to be concerned that we don't want to consistently undershoot on the inflation rate. There's been some discussion of central bank assets, and there are a couple charts that have highlighted this. The blue line here is the United States. It shows you how rapidly we've been increasing the balance sheet at the Federal Reserve. The red line shows you the United Kingdom, and the light blue shows you the euro area. So all the central banks in the world, as was commented on in earlier presentations, have been increasing their balance sheet. The United States has been pretty aggressive. Bank of England's been flattening out. The United States has continued to be expanding its balance sheet. One of the things that I would highlight is the United States, like the UK, have been countries where there actually has been a fair amount of fiscal restraint. So that fiscal restraint has in part been offset by the monetary accommodation. I think in the UK there's been much more appreciation that the more fiscal restraint that they have, the easier monetary policy will be. They've actually talked about it very explicitly. In the United States, we've not been anywhere near as explicit. So in terms of LSAPs and the improving economy, our unemployment rate is currently 7.5%. So that's down from the 7.8% last September. I used last September because September was the point in time where we started to once again increase our balance sheet. You can see that employment growth, and it was mentioned earlier, over the last 3 months it's been 200,000 jobs. It's been a bit bumpy, but as somebody else in one of the earlier panels highlighted, the employment to population ratio remains quite low. So the improvement in the unemployment rate has partly been a result of people pulling out of the labor force. That's not the way we want to get improvements in the unemployment rate. We want to get it because people are employed, not because people give up on getting employed. So one of the aspects is, while the unemployment rate has come down, and come down more sharply than most forecasters expected, it hasn't all been for the reason that we actually want. You actually need to have GDP growing faster than the 2% growth that we've been averaging if you really want to get improvements in labor markets. So I have a forecast that's not that different than Charlie's in terms of getting stronger growth going forward. That's really what we need in order to try to get the unemployment rate to come down. So people talk about how constrictive in Europe fiscal policy's been. So I looked at the real government spending in the United States, the UK, and the euro area, and this just looks at 2010, 2011, 2012. You can see in the United States that growth in real government spending, similar to the slide that I had before, has been quite negative over the last 3 years. You look at the United Kingdom, now this is just government spending, it's not all fiscal policy, but looking at the United Kingdom, it actually has reversed, and looking at the euro area, much more modest than what's happening in the United States. Another way of saying fiscal policy in the United States actually has been very restrictive. This provides an estimate that more fully takes into account what the stance of fiscal policy is. So it's looking at the structural budget balance. So it takes into account several things. One, obviously, it includes taxes, not just government spending. But it also takes the cyclical pattern that's going on in the economy and adjusts for the cyclical pattern. And if you look at the difference between the blue line and the green line, which is the amount of the structural deficit that is occurring from 2010 to the estimate for 2013, that gives you how much the structural deficit's moving. You can see a very substantial change in the United States. You can see that it's roughly of the same magnitude as the United Kingdom. And actually, the difference between the blue and the green line is more dramatic in the UK and the United States than it is in overall Europe. So my concluding observations, we are getting improvement in the overall economy. Accommodative monetary policy has been one reason for that. The interest-sensitive sectors have been responding about the way I would have expected them to. We have had a variety of headwinds. One of those headwinds is what's been happening on the government sector. Long-term sustainability of fiscal policy is clearly important, but thinking about the timing of that fiscal policy, I think, is also important. And the timing and the speeding of the restraint should be taken into account when we're thinking about fiscal policy. So it's not just monetary policy that should think about the strength of the economic recovery, it should be fiscal policy as well. So that concludes my report. I talked very quickly. Be happy to answer any questions that people have. You're about to get a microphone.
So there's been a lot of talk about the inflation expectations process, and I was curious to know whether or not anybody has done what Kozo did in his complex bilateral Granger causality chart, because one of the things that I noticed in his chart was that the thickest line went from the monetary base to topics. In other words, the asset channel. Whereas I think in my mind anyway, and perhaps even in theory, I don't know, the main driver of inflation expectations is the real side. In other words, the tightness in the product and labor markets. And so maybe foreign exchange, we could throw that one in as the third channel. So I'm wondering about what you think are the relative importances of at least the first two channels, the real side versus the asset channel, because of course the asset channel has been the most obviously positively affected by the LSAP programs.
So I wouldn't separate the asset channel from what's happening in the real economy. So the fact that the stock market is up and the fact that interest-sensitive sectors are doing well is in part the same thing. But I take your point. I would say I haven't seen a slide similar to that slide. It was a fairly complicated slide, so he was very ambitious to be explaining such a complicated slide. I'm not as good explaining complicated slides, so I thought it was very instructive to look at that. I would say that inflation expectations, we talk a lot about it, but we don't model it very well. So that economists have a very rough appreciation of how inflation expectations are set. There was a comment earlier about the Michigan survey. You can look at inflation forecasts by private forecasters. I'd say our ability to really understand that process is pretty rudimentary, and many models of inflation have not performed as well during the last 5 years as we might have expected, which would give you a little bit of pause about how good we're going to be about understanding exactly what sets inflation. But certainly the amount of excess capacity in the economy is one of the elements that I think is an important element. The stability of inflation expectations is clearly important, so one reason we haven't seen inflation fall further is because I think there has been inflation expectations that over the longer run, the Federal Reserve will be successful in hitting a 2% inflation target. So I think that has helped bound how low the inflation rate has gotten despite the very weak economy. The exchange rate channel is probably more important in Japan than it is in the United States. So I wouldn't expect the line to be as dark in the United States as it might be, or as wide, I guess, as it was in Japan, but it's certainly a channel that's relevant. So I think all those channels are important components. I'd say all those channels are channels that monetary policy has some impact on. So the focus of our policy is not to move the exchange rate, but the exchange rate does move as we move policy. And certainly the amount of GDP gap that we have is partly influenced by how accommodative our policy is as well. So it's not just the assets, but it's the GDP gap that I think has been one of the things that monetary policy has been focused on in order to try to make sure that inflation didn't fall further.
Please apologize if my memory is wrong, but something like 10 or 15 years ago when I read, maybe for the last time, the Federal Reserve Act, There's something about the objectives and the mandates of the central bank, and that is about inflation keeping down, about something about the labor market, and something about bond markets as well. The thing about bond market, how is that? Is that still valid? And how is it interpreted? Just coming back to the things we discussed this morning.
So I'd say most of the focus is on inflation and unemployment, and the expectation is that a low inflation rate will be consistent with a relatively low interest rate. So I think overall, people talk about the dual mandate. It really is, most of the modeling would be focused on how are we performing relative to a 2% inflation target, how are we performing relative to what we would expect in terms of what's happening in labor markets. So I think that's the construct that most people operate under.
I'm Timo from Finland. I have a background in central banking, and therefore in a way, I feel that I need to say where I have no problems with your presentation, and then I come to the other part, more difficult part. Okay. So in a way, I think one thing which is not commonly very well understood, that you should consider economic policy as a kind of wholeness, which means that if you have a necessity for restraint and fiscal policy, it makes sense to have more expansive monetary policy in order to minimize the negative effects. There, in a way, I fully agree with the logic that you said. But the other thing is that we also, in central bank world, we have used to think that there are issues which cannot be corrected by monetary policy. And then we typically think about structural problems in the economy. We have heard a lot of structural changes in your labor market. And basically, in a way, how I have learned to think about central bank policy, that's an issue which is not solvable by monetary policy. Then the third element is you have been describing, and I think someone else beforehand, that okay, the private sector has been growing on the level of on average on 3%, and the public sector, there has been no growth, or it has been very slow. And then it creates a problem for me. What kind of private sector growth would you strive for? To me, 3% is great. And in a way, I have the feeling that I have had a long time feeling that the Fed is trying to, in a way, create a situation where the economy need not pay for the price of the mistakes made before the crisis. And the Greenspan Fed was one of the contributors to those mistakes. So in a way, and when we then take into account the problems with that, I think everybody, and I'm sure that you agree, that there will be a great risk when time comes to the point when you start to exit and you start to sell or liquidate those papers that you have in your balance sheet. So I hope that you could evaluate a bit these issues.
So I think the second and third part of your question and comment really gets at how much is labor demand, how much is labor supply. And I think in general, while I would say that structural unemployment is important to understand and that monetary policy can't directly do anything about that, I think there's an open question of how much of it is labor demand and how much of it's labor supply. So there are a couple things that I would point to. One is if you can stratify unemployment rates, for example, by educational attainment. And so if you thought that we were hitting capacity in some areas, the highly educated people quickly became employed, that might be one place where you'd start to see bottlenecks occurring. But actually what you find out is the unemployment rate that's been coming down most dramatically has been for the lowest skilled workers, the high school educated. That's partly because the interest sensitive sectors have been doing well. So if you think about who gets employed from the interest-sensitive sectors, it's construction workers, it's auto workers, it's manufacturing sector. And so that unemployment rate has actually come down fairly quickly. So that isn't saying that there's no structural element, but I think a very large element is still the labor demand, that we have a lot of excess capacity in the economy. Other evidence for that is if we were starting to see a lot of bottlenecks, you'd start seeing wages and salaries go up. We actually have not seen wages and salaries go up. They've been flat to trending down. And that's one reason we've had a very low inflation rate. So if you thought that most of the unemployment rate was coming from the structural side, we should start seeing wage and price pressures. We're actually seeing the opposite. So it's kind of hard to argue that the inflation rate and wages and salaries are going down, but we have this great labor shortage that's preventing us from being able to attain the kind of growth that we otherwise would see. So I know there are plenty of anecdotes, but one reason we look at data is to try to square all this for the overall economy. And so my own assessment is that there's still a fair amount of capacity that we need to make up for, which is one reason why I think it makes sense to have an accommodative policy to make sure that we get the labor market to heal more quickly than it otherwise would. So in the absence of the accommodative policy, I don't think we would have seen the kind of improvement that we actually have seen. And I do think the interest-sensitive sectors have grown in part because we've had unusually stimulative monetary policy over the last several years. Does that fully address your question? Well, if I didn't think it was acceptable, I'd be arguing for even looser monetary policy. I think it's about appropriate for where we are in the economy right now. So I think we have a very accommodative monetary policy. We are seeing those interest-sensitive sectors responding. So I don't think it's evidence that monetary policy doesn't work. We're getting about the kind of response that we'd want to get in order to get the improvement in labor markets we've gotten to date. If there was a little less fiscal restraint, we probably would have a better outcome in terms of the labor markets and growth in the economy overall.
Eric, the GIC is thinking about a discussion or even a conference on bail-in versus bailout and the status of uninsured depositors. And we see an evolution underway in Europe. Where that's going to end up, we don't know, but it looks as if the uninsured depositor is going to develop a senior claim ahead of a bank bondholder. And in the U.S., we see the elimination of the zero interest rate demand deposit unlimited guarantee. So I really have two issues. One, do you have a view in terms of regulation supervision on these two issues? And the second one, perhaps, piece of the question is, does the shift to bail-in reduce any credit multipliers, which makes the central bank's work more difficult? Is there some risk premium we haven't measured yet that may alter that?
So the second one's easier, because since we haven't fully done it, I think it's hard to observe yet. But for the first part, I actually am very supportive of thinking about a bail-in concept. That seems to be the direction that Europe's going. It certainly seems to be the direction the FDIC is going for how they're going to deal with problem financial institutions. Dan Tarullo's given a series of talks talking about wholesale funding, which I think is a very important component of thinking about both financial institutions and financial stability. So requiring more subordinated debt is one direction that you could go, which makes it much easier to do bail-in because there's much bigger cushion. So it doesn't necessarily even have to be on the depositor if you have a very significant cushion for sub-debt and you're able to make sure that the riskiness of the institution doesn't get so great that you don't exceed the capacity of both the debt and the equity. So I think that is a promising direction to go. But I think actually thinking about wholesale funding more generally is still an important issue. So one of the things that we learned in the financial crisis was that you can have runs in lots of institutions, not just on banks. We had runs on money market funds. We had runs on investment banks. It's very disruptive to have a run on an organization. So even if deposit insurance doesn't have any losses at all, if you have runs on financial intermediaries, you have to be worried about that. So thinking about how we get a more stable financial system, particularly on the liability side of the balance sheet, I think is important not only for banks, but for broker-dealers, and I've given some talks focusing on broker-dealers, also for money market funds, that we still have a lot of structural change that hasn't really been fully addressed. And I think particularly for the broker-dealers and money market funds, those are two avenues that I think more work needs to be done to make sure that we don't have the liability runs that we've had. So we need to think about how to protect taxpayers, but we also have to think about how to protect the economy. So the taxpayer is the bail-in, but it doesn't prevent runs on financial intermediaries, whether they're banks or other organizations. I think that deserves as much attention.
Thank you. I was curious as to whether you found that the multiplier of effect of asset price appreciation has changed over the past few years, particularly its effect on consumer spending. There's been a lot of talk that there's a tremendous amount of pent-up demand, and now that both equity and housing prices have recovered, that this is just going to unleash a fairly strong consumer spending trend.
So in terms of the quantitative easing and whether it's having a different impact, I mean, the markets are definitely in a different situation than they were in 2009. So part of what happened with our quantitative easing in 2009 was it was badly disrupted markets. Bid-ask spreads had gotten very wide. So our quantitative easing was in part to improve market functioning. And I think it was fairly successful at doing that. We had the off-balance sheet items that David highlighted in his chart, and when we moved from the off-balance sheet to the purchases of mortgage-backed securities and treasury securities, in part we were trying to get market functioning in those markets that had been badly disrupted. So we went from liquidity programs to a purchase program that somewhat had the same intent. There was a very big impact on prices at that time, both on interest spreads and in asset markets, and I think that was partly reflecting the dysfunction that was occurring in a variety of financial markets. That's not the situation that we've had in 2011, 2012, 2013. So there is a different nature to what the quantitative easing's doing. But I do think that it's had an impact of the magnitude. If anything, I think the evidence that we've been getting recently is it's having a bigger impact. So when you look at what the Bank of Japan did, which was highly telegraphed event, as soon as the personnel were switched, it was pretty clear where the monetary policy was going to go. With their announcement of what they were doing, there was a very substantial impact on a variety of rates. So the exchange rate moved, the long bond rate moved, a whole bunch of financial assets moved quite dramatically. Not only in Japan, but you could argue there was a spillover effect in the rest of the world. So if you think there's a spillover effect in the United States and Europe from something that the Bank of Japan's doing, you must think that there's a pretty big own country impact as well. So I think some of the evidence that we've actually seen makes me more encouraged that quantitative easing can have a very significant impact. And getting back to Kathy's question, asset prices are one way that we do affect the overall economy. So the fact that housing prices is going up, some people are concerned that that's a negative. I actually view that as a positive. So if you look at the Case-Shiller index was talked about before. So if you look at the various cities in the Case-Shiller index, most of the positive increase has come from the cities that have been most badly impacted. So if you looked at the individual graphs, and I don't have a graph here, but it kind of goes, it drops down to about 45%. And there's been about a 9 or 10% pop-up in cities like Miami, Phoenix, LA, the areas that were most impacted. That's partly reflecting that that market is getting back to functioning, that the private sector is coming in. A lot of that is hedge fund money and other types of money buying up these vacant homes and turning them over to rental property. It's been a favorite strategy for hedge funds over the last 2 years to do that. I view that as a very healthy sign. That's where we're getting a lot of the price increases is from markets where the vacancy is very large. In cities that didn't have the very precipitous drop, like Boston, New York, Chicago, some of the other cities that didn't see the kind of movement, it's been much more mild in terms of the price appreciation. And I think that we need the price appreciation if we're going to get the housing sector to improve. So as long as housing prices are going to go down, no one wants to buy a house. It's the same problem Japan had. That if you think things are going to be, if it's a highly leveraged transaction and prices are going to be a good bit cheaper in 6 months, that's your expectation, you don't engage in the highly leveraged transaction, which is purchase of the house. In the United States, we saw that in the housing market. People were willing to defer there wasn't much cost to deferring, because if prices are going to be lower, you're going to be better off waiting. As soon as you start getting prices going up, and the possibility that at some time in the near future interest rates might start trending up, the dynamic completely changes. So the flipping in the housing market and the very large appreciation that we've been seeing in housing prices in some markets, I think is exactly what we need to see. We need people to be confident that prices are going to be improving. As that happens, you start seeing housing improve, you start seeing more construction employment. So it's a really positive sign that despite all the problems we have in the housing sector, you are seeing housing starts increase. So people are building new homes, even though there are still vacancies in many parts of the country. That is a positive sign that we're starting to get some of the capacity to go out, and we're starting to get some of the improvement in housing markets.
Thank you very much for a wonderful presentation that shows that there's as much active debate within the Fed as there is within GIC, and we think that's a very healthy thing.
Thank you.
Thank you very much. I'd like to ask our next two panelists to step up. We have Catherine Mann, a member of the board of GIC, a graduate of Lexington High School like me, a graduate of MIT, which is much more important, like certain central bankers around the world. And now the Barbara and Richard M. Rosenberg Chair in Global Finance at the International Business School at Brandeis University, and a visiting scholar at the Federal Reserve of Boston, which means she knows Eric very well. And also here he is. Carlo Favero, who is the Deutsche Bank Chair in Quantitative Finance and Asset Pricing at Bocconi. We have several Bocconi graduate students here with us. Very pleased that you would invite them. A big part of GIC's outreach is to speak to the younger people in our industry and introduce them to, well, the trouble that you have being an economist in the world today. Carlo's been an advisor to the European Central Bank, the European Commission, the World Bank. He holds his PhD from Oxford University. We look forward to an interesting response panel. Thank you very much. Did you flip a coin on who goes first? Ladies first. Ladies first. Catherine will go first.
Similar to Eric, I like to stand up and talk as well, but I like to stand closer to my slides because you'll see they're very complex, and so I need to be able to point out things, and these pointers never really work. So let me go back to my title, International Capital Flows at the Zero Lower Bound. Why are we interested in this? We are interested in this question because, as was said earlier, when you have a change in interest rates, say because of central bank policy, the asset markets move very, very quickly. And of course, they move across borders. So what I'd like to think about in this presentation, it'll focus mostly on what's going on for the United States, but I will have some comments at the end about what I see as potential issues going forward under both the policy, the Abenomics policy, as well as for potential avenues that the European Central Bank may take as its sort of next volley in its policies to try to revive growth here in Europe. So the question is, are these international capital flows and their movements a constraint on central bank policies in the past or going forward, or can we think of them as being in partnership with central bank policy? So let me put the numbers into perspective for the US. So the black line here gives me the reason why I'm even looking at this issue. The black line shows the share of foreign holdings of US Treasury securities. In 2003, it was about 38%. And at the end of 2012, it was 50%. So basically 50% of all the debt that we've issued in the United States is held abroad. So it seems to me we should be looking at what those holders are doing as we move through central bank policy of the last few years. Now, the other bars that you see here are the range or the various actors that I want to look at. The green bar is foreign purchases in each year. And as you can see, in the early 2000s, foreign purchases were pretty important in terms of augmenting their portfolio of U.S. assets. And the green dotted bar are the proportion or the foreign official purchases of U.S. assets, and we'll talk a little bit more about that in a little while. The blue is U.S. public, the domestic and corporate and bank public purchases. And the very small bars in the early 2000s, the ones here, the red bars are the Fed purchases. So, you know, back over here, you know, we maybe paid attention to the foreigners. Public was interesting, Fed, not an actor. We look over here, and we have a very different picture. We have foreign, of course, we have issued a lot more obligations as part of the response to the downturn in the U.S. economy. So all of those bars are bigger, but you'll note that the foreign bars are in some periods bigger than the public, but there are other places where the Fed is bigger than anybody else. So the interplay of the Fed and the foreign is what I want to be looking at. I don't want to talk about that one. Well, actually, maybe I will. So one of the things that we might, one way we might want to look at the various players is to look at the bond and bill auctions. So we can look at who is coming to the, well, we don't have all of the details, but we can look at who's coming to the auction, how much they are bidding, and how much they are getting at an auction. So these are various of the short-term auctions, and then these are the long-term auctions by the auction or the instrument class. And each one of these bars is the average bid cover ratio for all auctions of that particular class or instrument in that particular year. So we have periods well before the turmoil. We have periods kind of in the middle of the turmoil. And then we have the most recent years. And what we can see is that the bid to cover ratio, which gives us an idea about how attractive U.S. Treasuries are, gives us some idea of, you know, who wants them and how much they want them. So on the one hand, we can look at the shorter term ones. We can see that the bid to cover ratio makes it look like everybody really wants U.S. Treasuries. But it's also the case that they wanted U.S. Treasuries at an interest rate higher than the one that actually ended up being the stop-out rate at the auction. So should we be taking these high bid cover ratios as indicative of broad-based demand for these instruments? I think we should pause a little bit in our assumption that that's true. And in particular, when we look at these longer-term instruments, and I don't have 30 years here because we didn't issue them for all of these years, but we could look at them for the past couple of years, that you see for the longer-term instruments, that behavior of a strong bid-to-cover ratio is not apparent in the data. And this might be telling us something about that lack of interest in U.S. Treasuries that John Sylvia was commenting that nobody in his portfolio is going to own any of these. Now, who actually gets the bonds at the auction? There are a number of different bidder classes, and there are a number of different investor classes. And the data are presented both ways, and I've used them both ways. But since I'm particularly interested in foreign interest in U.S. Treasury auctions, I've presented this graph, which again looks at every single auction and then averages for the year. This is just for bonds from 2001 up to the most recent, or well, the auction that happened on April 3rd, so it's pretty recent. The share of that auction that was given or sold to two of the bidder classes, the foreign investor class, which is in the purple, and the blue investor class, which is investment funds. There's also a dealer-broker class. There are a couple of other ones, but these are the two, other than dealer-brokers, this is the biggest two other classes that are allocated at the auction. So the notable feature that I want you to take away from this is over here, the declining share of the auction that is bought, or they buy it, is given to foreigners, and the very rising share given to investment funds. Now, we can think of a number of different reasons why foreigners want to hold assets, part of their portfolio of central banks, part of their liquid portfolio for commercial banks as they build up capital. Thinking about what investment funds might be doing with this asset class after John has told them not to have any of it, one can think of arbitrage opportunities against the Fed as being one thing they might be thinking about doing with this asset. So that gets me to look at, okay, so what is happening in the cross-border arena with regard to various kinds of asset classes? So these data are presented annually for the kind of right before the crisis, and then quarterly up to the most recently available. And we're looking at gross cross-border flows in 4 different asset classes. You had inflows and outflows, so that each one of these colored pairs, they're basically right on top of each other because the gross flows are extremely large both in and out. U.S. Treasury flows, for example, reached their peak here in, right about here, at $18 trillion in that quarter at an annual rate. So what we're looking at here is a period of time when the U.S. Treasury cross-border flows, this is of long-term U.S. assets, so this is long-term U.S. Treasuries, none of the short terms are involved here, and that is the dominant, by far the dominant asset class that is cross-border international capital flows. However, before I get to these two in just a minute, I want you to note that there was a period of time when foreign cross-border flows, foreign interest in U.S. equity assets, the blue is equity assets, was very, very attractive to foreigners, cross-border sales and purchases. If the Federal Reserve's policy is to get investors to get into a riskier class of assets, then one of those investors that we might want to get into risky assets would be not just our own investors in the domestic marketplace, but also foreign investors coming into our markets. And the indication is, we'll look at the flat line here, there's no appetite on the part of foreign investors for buying into the U.S. market. So that's to the extent that we would hope that a quantitative easing program would push investors out the risk spectrum. They are doing it in the domestic market, going into the equity markets, but there's not evidence that they're doing that if they're foreign investors. Now let me just point out the purple here. That is corporate foreign investors in corporate bonds. Not a very big gross flow by any means. I mean, it's practically on the bottom of the chart, and it doesn't seem to change very much either. But that is going to be, of course, one of the most important features of the net flows that we're going to look at in a minute. You also see GSEs there, which we could talk about, but I'm not going to. We'll talk about the net in a minute. So looking at this picture here, which is the quarterly data, how does this behavior of the quarterly data on the U.S. Treasuries, is there any sort of relationship to that quarterly data and the quantitative easing announcements that were made in the FOMC statements? That's what this chart looks at: monthly data, not seasonally adjusted, monthly rate, to get a picture of whether or not there's any behavioral relationship in the international cross-border flows and the quantitative easing statements, taking the statement as the FOMC statement. Now, there could be a lot of other dates that one could choose, but I want you to focus on this part of the chart. And I've put some dotted lines in to kind of give you a flavor of what I see as some relationship between the cross-border flows and what the statements have been. So during a period of time when we did QE1, building up the balance sheet rather substantially, the foreign cross-border flows responded actively entering that market to buy U.S. Treasuries. At the long term, this is again long-term U.S. Treasuries only. When the statement was we were done with quantitative easing and the balance sheet was not expanded anymore through buying of U.S. Treasuries, the market is flat. QE2 comes in, market responds, increases cross-border flows. Ended QE, no more expansion of the balance sheet. And then here we are with where we're not expanding the balance sheet anymore, but we're changing the term structure. And at that point, the market, as defined by gross flows of private actors in the, or actually all actors, no, this is private, excuse me, private actors through the cross-border flows really collapses. So who is it in that set of actors in cross-border sales, purchases and sales, who is responsible for this really dramatic decline in gross cross-border flows? The lines underneath, the various colors, are various private financial centers. You've got the green, which is the UK. You've got the purple, which is the Caribbean financial centers. And you have the blue, which is the Euro area. Now, for a number of different reasons, these financial centers are both acting as, you know, a regional entity, but their role is also as a major conduit for financial arbitrage. And so the main reason for the decline in the cross-border flows is because of the decline of private actors arbitraging through these financial centers. The two players that we usually think about when we talk cross-border U.S. Treasuries, the two actors that we usually think about when we talk about that, we talk about China and Japan. They're the bottom two lines. They are not what's driving the magnitude or the dynamic of cross-border flows. The dynamic of gross flows is driven by private actors. It's driven by an arbitrage community that plays a role in the market. And because 50% of the market is domestic and 50% of the market is foreign, they're playing against the Fed. Now, when we look at the nets, this is taking those two lines and, you know, taking the difference between the two of them across the asset classes, we get a somewhat different picture. And this is the picture that most people look at when they look at cross-border flows. They look at the nets. And we get a picture where in pre-crisis, annual rates, looking at the pre-crisis, we had that, when I mentioned that green line, the corporate, you know, the corporate bonds back here, this corporate bonds here, being like not interesting, there's nothing happening, tiny gross flows. Pre-crisis, that green, this corporate bonds, was the major, major financial financing in terms of net flows into the United States. And treasuries, which are the various colors of orange, private and official, not very important, pre-crisis. All of this is quarterly data about the post-crisis period, where we see an awful lot of action happening with foreign official institutions, that's the hashed reds, buying treasuries, sometimes the private guys, which is the solid, totally out of corporate bonds. Once again, out of the risk perspective. And we also see an awful lot of, in the gray, cross-border banking flows in an effort to bring money back home from the subs abroad in this period here, bringing them back, everybody bringing their money back. And as the rolling financial crisis, we're seeing it coming back again to try to balance the situation in banks in Europe. The one little piece of evidence that I see on taking up a little bit more risk on the part of the foreigners, if you're really desperate to find that, and I look for it, is a little bit more interest in the corporate bonds. So I would like to finish by looking a little bit more at, or I'd like to finish my evidence by looking a little bit more at the official portfolio at the zero lower bound. So I'm looking at all of the foreign official entities, and I'm asking what kind of purchases, what's been the portfolio? What do they look like they like to hold, to buy and hold? So back in, the good times, yeah, they held a lot of U.S. Treasuries. That's the long-term and short-term. They also held a lot of GSEs. That's the sort of solid pink color. They really wanted to own something other than U.S. Treasuries that gave a higher return but was completely risk-free, or they thought it was risk-free, and it turns out it was risk-free, the GSEs. But they were also interested in holding some private assets, and that's the blue. Okay. So even among the foreign portfolio, there was at the time, prior to the financial crisis, a move towards a riskier portfolio of assets. In the crisis, as it develops, of course, there's a complete movement towards U.S. Treasuries and away from the other two asset classes. So what does all this mean kind of for going forward? Implications for central bank policies going forward. The first question is, who is going to buy U.S. Treasuries going forward if foreigners are really not interested and have exited left the auctions? Who is going to buy those treasuries at a time when the Federal Reserve might be exiting? They don't have to, but they might be exiting, and therefore selling some of those assets. We're going to continue to sell assets coming out of from the fiscal deficit side. So there's a question about a potential double whammy on the supply side when the demand for those assets has retreated. What about the European Central Bank? Any sort of issues for them? I go back to this bank diagram, looking at the gray. So one of the possibilities that the European Central Bank has put forward is negative interest rates on the excess reserves. If that is the chosen policy, we can be sure that these gray bars that are negative now will be positive. All be coming into all that bank money borrowing from the European Central Bank will be coming into the United States and sitting here. What it'll do here, I'm not sure, but it'll sit here. And so the implications of the European Central Bank policy in a cross-border sense really does need to be considered. What about Abenomics and the possibility, where is the Japanese money going to go? Is it going to stay in Japan, which is where they'd like it to be, or is it going to leave Japan? Maybe they actually want it to leave Japan because then the exchange rate will depreciate even more. But if it comes to the United States, then which of these asset classes will that additional liquidity buy into? Will the Japanese buy into U.S. Treasuries? Will they buy into other asset classes? The evidence of what they have, both China and Japan, I come back to those, everybody thinks of them as being the largest players in the U.S. Treasury market. But over the last 3 or 4 quarters, their participation in U.S. Treasury purchases at quarterly rates has been much smaller than everybody else. So the other foreign entities, we cannot look to China and Japan to buy those US Treasuries anymore. Their interest has waned, unless, of course, we can have Abenomics stoke up the demand for US Treasuries again. Thank you.
Okay. I'm very pleased to be here, and it's been also a lot of fun, at least so far. So let's see how it goes now. So monetary policy and long-term rates in the euro area. So the idea is that I'm going to be looking at the interaction between fiscal and monetary policy in the context of the euro. And here is my executive summary of what I'm going to talk about. So I think there is an obvious problem in the transmission mechanism of monetary policy in Europe, which is that we have one monetary policy and many long-term yields. So I will entertain you briefly on the factors. So why do we have many long-term yields? Because there are spreads in the euro area. And so I will discuss a little bit about what are the factors behind those spreads. And I want to emphasize the following factors: the importance of default risk, which is well known, but also the importance of a factor which has been silent for most part of the euro period, that is becoming important, at least until Mario Draghi's statement, we will do whatever it takes, and believe me, will be enough, which I label the exchange risk factor. And then I also want to make a little minor point on the importance also to flight to safety towards German bonds. And then this exposition of mine will, I hope, illustrate to you why the statement by President Draghi was enough to change the exploding, I dare say, behavior of the spread. And then I will take it from that point onwards to assess a risk scenario. And the risk scenario that I see is that we move from a confidence crisis, which it's beyond us, and it was due to spread between yields, to a sustainability crisis, which might be in front of us, and it will be due to the level of yields. And the mechanics of this sustainability crisis works as follows, that German bonds and US bonds are very close substitute. So QE is now determining a very low level of safe yields with possibly a negative risk premium, and I'll just spend 2 minutes on that. What happens to these yields in the euro area when the Fed will implement the exit strategy? And what is important is not only what happens to the level of German yields, but what is going to happen to the level of different yield across the euro area. And my bottom line is that in order to have sustainability when R is going up, there is only one way to push up G. So Europe needs, and by G I need the growth rate of GDP and not public expenditure, of course. And Europe needs growth badly and fast, and I think that cannot come from monetary policy, at least in the euro area. So here is the big picture. One monetary policy and many long-term yield. The thick black line is the monetary policy rate, which we call the ONIA rate, which is a single one for Europe. And you can see then an array of long-term rates. In fact, from the inception of Europe to 2009, you don't see many sizable spreads. Spreads start becoming important with the euro debt crisis, and of course there is no Greece in this picture because it would have been above the limits. But you can clearly see that one wonders if it's possible to implement a common monetary policy in an area where you have long-term rates. These are the 10-year T-bond rates spanning from 16 to 1.6% along the cross-section dimension. So the question is, what is determinant of spreads in the euro area? And I've been working for a long time on bond spreads in the euro area. And of course, being an econometrician, you like to have many data coming from the same regime. And you have many data, true, when you have lots of volatility in this data. But I'm afraid in the case of Europe, they don't come from the same regime. So you have to be careful in how you select your sample or how you select your econometric methodology, because structural breaks are pretty important. So I think that this is pretty standard. You can write down a factor model of the bond spread in the euro area, and I think 3 factors are important. The first one, it's the obvious one: credit risk. Sovereign issuers are perceived as having a greater solvency risk must pay investor a default risk premium. We are in Milan, so there is an obvious case here. The second, and which I think it's a factor that has been silent for a long time but then became important again, is expectation of exchange rate fluctuations. The last component is liquidity risk, which of course is the risk of having to sell or buy a bond in a thin market, and thus at an unfair price and with higher bid-ask spread transaction costs. This is my take. A prominent feature of the euro area bond crisis is the resurgence of the expectation of exchange rate fluctuation. And let me just make my argument by looking at the failure of empirical model for euro area spreads. So the standard approach to model spreads in the euro area is based on a this comes from an array of models. Some of them have been proposed by the ECB, some of them by academic researchers, some of them by practitioners. So the idea is that spreads are modeled by projecting them on a combination of local fiscal fundamentals, and of course what matters here is expected fiscal fundamentals, so people typically take European Commission projections of debt and deficit, and some proxy for global risk aversion. Here, the VIX is a very widespread used variable, but also the spread between BAA and AA bonds in the US. And if you look at how a model of a factor model like this fitted the data, it did a splendid job up to 2009, which means also during the subprime lending crisis period. And this happened in the absence of expectation of exchange rate fluctuation in the euro area, which means some non-negligible probability of a euro breakup. And in the presence of co-movement between the dominant credit risk factor and the secondary liquidity risk factor, which is typically not included in this type of model. However, with the onset of euro debt crisis and the emergence of probability of exit of some countries, there was a generalized predictive failure of all this model, because there was an omitted factor there that started becoming important. And I dare say that a large part of this predictive failure, so people when the spreads on Italian, Portuguese, and Spanish bonds started shooting up, said, well, there is market irrationality, there is contagion. And so, this issue of having spreads implementing fiscal discipline on southern countries is really a dangerous one if markets are not pricing bonds rightly. But as a matter of fact, you cannot explain all the movement, but a much more important part of the movement if you try and have proxy for this latent factor, which is expectation of exchange rate fluctuation. And this expectation of exchange rate fluctuation, or devaluation typically, can be modeled via the dependence of each country spread on all other country spreads and fiscal fundamentals. The idea here is that there is an obvious channel of contagions, because everybody is doing badly in terms of fiscal fundamentals. The probability of a euro breakup goes up. So the Italian spread is going to depend not only on what the Italian government is doing, but on what Europe is doing to address the problem of excessive debt and deficit. So I think I'm not going through the econometric model, but I'm just giving you an intuition by looking at the data. I think this is an interesting graph. I concentrate on the BTP, which is the 10-year Italian government bond, and the Bund spread. And I'm taking a sample of monthly data that consider the pre-Euro period from the beginning of the 90s to 1999, then the first phase of the Euro period, and then the last phase of the Euro period. So if you look at the red line, which is the BTP Bund spread, you can see that there were wide fluctuation of the spread before the inception of the euro. And of course, these fluctuation of the spread were due to expectation of exchange rate devaluation. Then we converge into the euro, expectation of exchange rate devaluation disappeared, and the spread behaved in a very tamed way, I would say. And then, with the two crises, first the US crisis and then the local euro area crisis, you had the spread picking up. And over the last part of the period, you can see that the volatility of the series resembles the volatility that the series had in the pre-euro area era. Now, I'm reporting here the red line, along with three other lines. Blue and green are the Italian fiscal fundamentals, debt to GDP and deficit to GDP. And the black line is the BA minus AA spread in the US. And you can see that there is a potential for the BA minus AA spread to explain the fluctuation of the Italian BTP Bund spread during the US subprime lending crisis, but this potential has totally disappeared during the euro area crisis. And also, you can see that it's very hard to match the fluctuation in Italian fundamentals with the spreads during the crisis, because there is much more variation in the spread than it's warranted by the fluctuation in the fundamentals. Now, you can get an idea of what's going on if you compare the government bond spreads with the CDS spreads on the between. This is the blue line is the bond spread. The red line is the difference between credit default swap for Italy and Germany and for all these other high-yielding countries in Germany. And you see that over the last part of the crisis, something which is interesting emerges. If you look at the first part of the sample, the CDS spread and the bond spread had a kind of perfect movement, and in fact, they were superimposed to each other. Over the last part of the crisis, there is a gap opening up. This gap is proxying the exchange rate devaluation risk, right? Because the CDS spread is not affected by that, while of course the bond spread is. Now, and I think that the strong statement by Draghi helped in getting back down the exchange rate devaluation risk. Now, in addition to this fact, I think we have another fact, which I think is important, which is that there was flight to quality to German bonds. And you see it in this very simple graph, in which you have the blue line is the yield to maturity of 10-year bonds in Germany, while the red line is the fixed interest rate on swaps in the euro area. And you see that in the pre-euro area crisis, the two series are moving together. And again, there is a gap opening. And the gap is such that the German bonds yields is below the fixed interest rate on swaps, which is an indication, if you like, of a negative risk premium on the German bonds. The difference is the black line that you see at the bottom of the graph. So spreads got wide for two reasons. One was flight to quality or to safety, as you would like, to German bonds, and the other was the emergence of an exchange rate depreciation factor. And I think the importance of the exchange rate depreciation factor was the reason why then, since the Draghi statement, we saw spreads coming back. And as it was noted this morning, rightly so, I would say, spreads have been coming back without any, big movement in fundamentals, right? And I think there was just a shifting expectation equilibrium, right? And so my view is that this is a clear indication that the euro area crisis has been so far a confidence crisis in the euro, and strong statement by the central banks and a backing up by the government of the possibility of stepping in if necessary has been sufficient so far to unravel this crisis, to counteract this crisis, and to bring spreads back. And of course, weaker countries in terms of the fiscal fundamentals were more strongly affected because in case of a euro breakup, there were the obvious candidate for getting out of the euro, having heavy devaluation. So a small probability of a heavy devaluation, it translates in some spread. And the adjustment process, which went on in Europe, and let me just have a side remark about the very interesting presentation by President Rosengren. He has an interesting comparison about the fiscal adjustment in US and Europe, and one of the points he made is that despite a stronger fiscal adjustment in G, government expenditure, the US has been doing clearly better than the European economy. Now, of course, there are two possible explanations for that. The first one is that there has been a better accompanying monetary policy for any reason. The second, which I think it's something that you have to take into account, is that we have been looking only at G. But if you look at taxation, you find out that the fiscal adjustment in Europe has occurred through taxation. And so I think this might be taken as an indirect evidence that the fiscal multiplier, when you do the adjustment through G, is much more likely to be prone to non-Keynesian effect than when you do it through T. And I think that the big mistake of Europe, it's not being in terms of monetary policy, but in terms of the composition of fiscal policy. If you take the example of Italy, which has done the strongest fiscal adjustment, the Monti adjustment, alas, was done entirely through higher taxes, and G was kept almost constant. And of course, that has a stronger negative impact on the economy. And I think that the Keynesian story that if you do the adjustment through T, you get a smaller multiplier than if you do it through G, it's simply not compatible with the empirical evidence. But that is just a side comment. But as I said, there was an adjustment, and the adjustment paired with a clear statement that the ECB will do whatever it takes to save the Europe has generated a convergence process of spreads. But now, here is my risk scenario, and I love risk scenario, so I enjoyed very much presentation this morning about risk scenario. So, you know, one of the strongest example of co-movement over the last 20 years of data, you get it when you look at yield on German and US bonds. Here is the graph. And this is, it's even more striking if you think that, you know, these two yields are on securities that are denominated in a different currency, right? So it seems that the random walk model for the exchange rate works very well at the 10-year horizon. But this picture tells me that, well, of course, you might wonder about this picture, but I've been wondering about this picture for a long time. But one of the things that you start worrying about is that, well, we are hearing talks of the US coming out of non-conventional monetary policy. But if that is the case, something is going to happen to the benchmark rate in Europe as well, because it will co-move. If this co-movement is not subject to a structural break, as US Treasury will go up, the German bonds will go up. And that creates an interesting problem for Europe, because you might have a traditional sustainability problem, because as soon as the cost of financing the debt goes up, the only way in which you get sustainability is by having a higher rate of growth of GDP. Now, this is my picture about safe havens. Let me just add a little bit of my view on the so-called bond bubble. So it's, well, we all know here that long-term rates are determined by two unobservable, alas, factors, which are expected monetary policy and the term premium. Now, my view is that there is a non-negligible probability that QE has generated a negative risk premium on US long-term bonds, which is paired with a negative risk premium on the German bonds. So what will happen to Europe when an exit strategy from QE is implemented by the Fed? Why do I say that there is a negative risk premium? So this is federal fund rates and US 10-year yield to maturity. So of course, in order to find the risk premium, you must have a projection for the course of US monetary policy over the next 10 years, take the average, see if that average is less or is higher or lower than the green line, and you get the risk premium, right? You know, there are several models around of the term structure, and if you use this model of the term structure, using a good chunk of them, you get a negative indication for a negative risk premium. Let me give you some indirect evidence, which I think it's for the existence of a negative risk premium, which I think it's indirect but still very interesting. What you see here are two variables, the blue one and the green one, where the green one is a market-based measure of risk, which is the VIX, the implied volatility in options on the Standard & Poor. The blue one is a non-market measure of risk, which I've taken from the website of Nick Bloom at Stanford. Nick has done lots of research on uncertainty in the cycle, and with co-authors, Baker and Davis, he has produced a non-market-based measure of uncertainty, which is, it's a weighted average of three underlying components, which is newspaper coverage of policy-related economic uncertainty, the number of federal tax code provisions set to expire in future year, and disagreement, the cross-sectional dispersion among economic forecasters, right? And if you look at these two different measures of risk, until recent year, you run a regression of one of on the other, and if you don't worry too much about endogeneity, you get an R square which is very close to 1, right? It's like saying the correlation is perfect. But since the inception of non-conventional monetary policy, these two measures have, there is a gap between these two measures, and it seems to be that the market measure of risk is giving you an underestimate with respect to the non-market measure of risk. So this is something that makes you think, because you might see QE as creating a distortion in market prices, but I don't want to push this too far. What I'm just saying is that because you have a negative risk premium, the movement in the level of rates might be really faster than you think when the normal picture is restored as the Fed starts unraveling or coming out of QE. So I mean, it seems to me that there is a consensus that there is only one way for US long-term rates, but if you believe that story, then you must think what happens to European rates. And it's, you know, historical evidence tells you that the German Bund is a very close substitute for the US Treasury, so they will move together. But if then they keep moving together, then you have an obvious question about what's going to happen to all the Euro area countries who have enjoyed the support of the Draghi policy so far, and have seen spreads coming down because of the statement, believe we be enough, has been sufficient to destroy, I would say, the exchange rate depreciation risk. But now we are back to the usual business between the sustainability, and it's a matter of comparing the level of short-term rates with the not anymore the spread, but the level, with the growth rate of the economy. And of course, the bottom line is that within this new scenario, Europe needs, in order to avoid the sustainability crisis, Europe needs growth. And growth must come from other sources than monetary policy, because it's evident that when the US will be coming out of the QE, there will be the long-term interest rate in Europe will follow up, and therefore we need to implement structural reforms very fast. And time is really ticking, because I've seen some dating this morning, and the dating does not go beyond the end of 2015. And for implementing structural reforms, I mean, 2 years, it's not a really long period, especially if you have an iffy government and there is lots of uncertainty on the type of political equilibrium that will emerge. And to me, this is the risk scenario for Europe.
Thank you both for very interesting discussion. I had a question for each of you, if I'm not overstating my welcome. Catherine, one of the slides that you had at the beginning, and I'm not sure whether I missed something in the gross versus net, but it seemed to imply that the foreign flows into the US at the time when the US had QE, and these flows went into treasuries. So essentially negating the obvious of, risk appetite, the ignition of risk appetite. If this is the correct interpretation of that chart, that occurred really at the time when indeed you did have QE1, but more importantly QE2, but it occurred at the height of the European crisis. So to what extent were these flows then really a flight to quality that overrode, if you will, the effect of QE as such? So that's one question. And I don't know if I should ask you, Carlo, immediately the question or wait for your answer. What would be the best? Yeah.
So two observations. The first one, when there is this rolling geography of crisis, event studies or event dating is always a question, because I dated my events from the standpoint of U.S. policy and monetary policy announcements. And I could alternatively have chosen another set of dates based on what's going on in Europe. So there is definitely a relationship between the European flight to U.S. quality and their crisis. But I think that especially the reduction in foreign interest in U.S. Treasuries in a cross-border gross flows sense precedes and continues through the European crisis and the Draghi statement about we'll do whatever it takes. So I think that what's driving that big decline in the gross flows that we observe is more U.S. monetary policy stance rather than European flight to, rather than European reaction. You noted that sort of what is this tension between huge gross flows of U.S. Treasuries and their the decline in those gross flows over the past, say, 6 quarters, 8 quarters, and that during that same time period, the net flows are predominantly U.S. Treasuries. Those are both true statements. There's been a decline in gross flows at a time when net flows are larger. I think you get different signals about risk appetite from those two different charts. I think you get a decline in interest for U.S. Treasuries overall from the gross flow chart, and a decline in risk appetite. And well, if I have to hold something, it's going to be U.S. Treasuries from the net flow chart. My point is, one should be looking at both gross and net and interpreting those as part of a picture of the relationship between cross-border interest in a lot of U.S. asset classes, that you can't just look at the net flows and interpret that. Well, we can do holdings. That would be holdings, right? Now, exactly. the holdings of, there's, one looks at a portfolio either in portfolio weights of the portfolio or portfolio weights of the purchases, which would be the margin. And yes, both ways of looking at it are important.
And my question to you was with regard to the differentiation or lack thereof when you hit the crisis and the periphery, you saw this widening in spreads relative to bonds. In your mind, do you think that the market has ignored, if you will, a country when it's looked upon like a balance sheet, i.e. with assets and liabilities, and I'm thinking Italy and Spain, Italy with a low public debt but a high private debt, and in Spain it's high in both cases, and that distinction does not seem to, it's only recently that maybe we see that distinction, but in the height of the crisis that didn't happen. And if so, what do you think is behind that lack of differentiation?
So I think this is an interesting, important question. If you look at the wealth of Italian households, and you take a Barro perspective, so you take out holdings of public debt, the wealth of Italian households is over 3 times GDP. So where is the problem, right? So we have a government debt of 1.3% of GDP, and Italian households that hold 3 times GDP in terms of their wealth. But the problem is that I think this wealth does not flow to the productive sectors, in the sense that we have high wealth, low income problem, and so, and also there is the problem that the top 5% of the individuals holds 40% of the total wealth. So there is a distribution problem, and then there is a problem of low growth, right? So I think that one of the reasons why the markets have not been taking this into account is exactly the fact that most of this wealth it's not in productive sector, it's in housing, right? And so it's very hard to get this wealth at work to make Italy grow, right? Because again, the dynamics which is relevant here is the dynamics of the cost of financing the debt against that of GDP growth, right? And until we will get prediction that G will be lower than R, it's going to be very, very difficult to have stabilization of the cost of financing our debt, right? So I think that the reason why market have not been pricing the fact that there is lots of wealth in Italian household is that this wealth does not translate into growth, and you need growth to avoid continuous fiscal adjustment.
Yes, for Carlo. So I agree basically that they've solved sovereigns and taken out the risk that people are going to leave, yet I guess I also agree that transmission mechanisms broken. And while that's necessary, and even some European corporates in Italy, Spain are issuing a lot, it seems the hidden part of that transmission is the banking sector. And in fact, bank lending shrinking, and if anything, further news here, if you sort of Googled everybody talking about zombie banks in the last 2 or 3 weeks, you'd see some fairly large increases. So I wonder if you could talk a little bit about that, that as part of the sort of credit crunch, if you will.
So this is interesting because you can get a joint answer, because Catherine and I were just discussing this issue this morning. And let me take you back to my notation that we are living in a world where the risk premium is negative. If the risk premium, of course, the risk premium on US and German bonds. In a world like this, there is an interesting way in which the transmission mechanism of monetary policy it doesn't work, because if you can borrow at zero, then you can think of a rolling investment in the risk-free rate that gives you more than zero. Of course, there is an arbitrage opportunity, and you borrow, but you don't use that borrowing to finance, real investment, to finance the productive sector. You just invest in the risk-free rate. So the hurdle for rate for investment, it's not the long-term yield that you observe in the data, but it's the expected average monetary policy rate, which of course it's higher than the long-term rates if you have a negative risk premium. And that could be the reason why you have difficulties like this in the working of the traditional working of the monetary transmission mechanism. In fact, I think this point was made by Professor Stein in a recent talk, and I think it's an important as I was saying before, you might worry that QE is distorting market pricing, right? And you can see it by looking at the VIX. You can see it maybe by looking at the negative risk premium. And the point that you make about the malfunctioning of the monetary transmission mechanism is another way of looking at this fact of distortion of pricing.
The last comment that I'd make on this this point is if I go talk to my students about what should we be using interest rates as a how should we think about interest rates as part of the transmission mechanism from monetary policy to the real economy, they'll usually tell me the story, well, lower interest rates means that more projects reach hurdle rates of return, and so more investment will be undertaken, and the IS curve shifts out or moves down, or we move along the IS curve. And that's a valid way of thinking about how lower interest rates are supposed to stimulate investment, because more, as I say, projects reach their hurdle rate of return. But another way of thinking about interest rates is, of course, that interest rates are equal to the marginal product of capital in equilibrium. That's true. So a negative real interest rates means the marginal product of capital is negative. So why would anybody want to undertake any investment at all if the marginal product of capital is negative? So we end up with, thinking about, or should we be thinking about interest rates in the dynamic sense, more project reach hurdle rate of return, or should we be thinking about it in the equilibrium sense, which is nobody's going to make any investment at all because it's going to give them a negative return? I think my observation is we have more people who are thinking about the second view than who are thinking about the first view. And yet our policy strategy is based on the first view and not on the second view. So that's a conundrum.